Well, hello everybody, and I do hope everyone is well. And I want to kind of do a little stuff from the textbook on chapter 3 here. And so I want to start off by these videos in your textbook are really good. So I want to start off by running this video, okay? Because this will give you an introduction on what's going to be going on in this chapter. We're going to be looking at the different statements companies use, to analyze for the shareholders and the stakeholders, the managers to analyze how they're doing. Okay, and we're going to create these ratios, and I'll talk more about that in a bit. But for now, I just want to run this little 4-minute video.
Suppose I tell you that my friend Mark runs a business and that his business made $1 million profit last year. Would you be impressed? Most people would probably say that a business generating that kind of profit is doing well. But what if I added that my friend Mark's last name was Zuckerberg? Knowing that Mark Zuckerberg runs Facebook, you'd probably say that a profit of just $1 million was a poor showing, and you'd be right. The larger picture here is this. It's important to monitor a firm on a continual basis to see if it's achieving its goal. A firm's managers, its investors, and even its regulators rely on the firm's financial statements to assess how it's doing. And they apply a variety of tools to analyze the information contained in those statements. This chapter is about the financial statements that a firm produces and the tools that you can use to analyze those statements to judge how a firm is doing. In the first part of this chapter, we provide a brief review of the key financial statements: the income statement, the balance sheet, the statement of retained earnings, and the statement of cash flows. These documents provide the raw data that investors use to see how the company is doing. But the chapter's main focus isn't on the financial statements themselves, but rather on how you can use financial ratios to draw conclusions about a firm's performance. There are dozens of useful financial ratios. They may focus on a firm's ability to pay its short-term bills, on the efficiency with which it manages its inventory, on its profitability, or on a number of other dimensions. The purpose of using ratios is to tell a story about how a firm is doing. To illustrate, let me go back and explore the issue of profitability a bit more. One measure of profitability is called the net profit margin, which is just the earnings a firm generates for its common stockholders divided by total sales. To determine how profitable a firm is, or frankly to assess how effectively management is running a business in almost any dimension, we usually look at financial ratios in two ways. First, we conduct a time series analysis to see how a particular ratio has changed over time. The blue line here shows the net profit margin for American Airlines from 2013 to 2016. You can see that the airline actually lost money in 2013. Profitability improved for the next 2 years before falling a bit in 2016. Notice that the net profit margin fluctuated a great deal, from about a loss of 7% to a profit of 18%. Even so, there's no particular trend observable here, just a tendency for the net profit margin to bounce around quite a bit. Essentially, the story we would tell is that American is generally profitable, but it seems to operate in a fairly risky business. The second way that we look at financial ratios to tell a story is to conduct a cross-sectional analysis that compares a firm's ratios to those achieved by its competitors. The red line shows the average net profit margin for the airline industry over the same period. Comparing American Airlines numbers to the industry average helps us assess whether American is performing better or worse than other airlines. Notice that the average net profit margin for the industry bounces up and down, just like the American net profit margin does, though not quite to the same extent. Here again, American's profitability, relative to the industry average, shows no obvious trend. American earned a higher net profit margin than the industry in 2014 and 15, but it lagged the industry in 2013 and 2016. So the story here is that American's profitability is more or less typical for the industry. That might be a little surprising in light of the fact that American is the world's largest airline. As you read through the chapter, you'll see that we provide a thorough analysis of Whole Foods just prior to its acquisition by Amazon using financial ratios. What story do those ratios tell about Whole Foods' performance, and why Amazon might want to acquire the upscale grocery chain.
Okay, so moving on after that. So we're going to look at these 4 financial statements that the gentleman mentioned, right? Income, balance sheet, retained earnings, and cash flow. Cash flow is very important, okay? And we're going to derive a whole bunch of ratios off them to, to understand what's going on. And why do they do these statements? Basically because you need to understand why different, firm stakeholders will have an interest in the firm's financial statements and how these stakeholders will analyze the statements and to look at your performance, right? Kind of like when you go for a job, they want to see your resume and see what you did, right? They want to see what your performance, where you previously worked, your education. Okay? So there's a lot of reasons why people want to see these. Marketing wants to see them. And operations. And all these pieces make up portions of the statements. All right, so again, and you go back into your personal life, a routine step in personal, this is real important, personal financial planning is to prepare and analyze personal financial statements so you can monitor progress toward your financial goals. And again, this is very important. You want to build up a nice portfolio so you can retire someday. So they're gonna, they use Kroger as an example here, and then they go into Whole Foods. But you can read these case studies, and they're quite interesting. So as it says here, financial statements contain a wealth of information, but digesting that information is not easy. One way analysts put financial data into perspective is by calculating a variety of financial ratios. These ratios help give them an idea of how a firm is performing, not only in an absolute sense, but also relative to its competitors. In this chapter, you'll learn how to use financial ratios to assess a company's performance. So that's what the whole goal will be in chapter 3. Okay? Okay, I thought I was changing. Let's see what happens here. Okay, here we go. All right, so basically what you're going to see that is not one of the statements is there's a document that I feel is very, very important. And it's called the Stockholders Report because I'm a shareholder or a stockholder, okay? And every company has to generate a Stockholders Report. So you can see what it says. Every corporation has many uses for the standardized reports of its financial activities. Periodically, companies prepare reports for regulators, creditors, owners, which is me, I'm the shareholder, and management. And they've got to use this concept called General Accepted Accounting Principles. And I'm sure some of you have taken accounting, right? And this is the practice and procedure guidelines used to prepare and maintain financial records and reports, okay? And they're authorized by FASB. So you should look up and make a list of all these terms. They're important. Okay, and then Sarbanes-Oxley came around after all the big accounting scandals that went on. Okay, so there was more oversight generated by Sarbanes-Oxley Act. Some of you may actually be working with the Sarbanes-Oxley Act. All right, so what companies do is, when I get my stockholders report, right, my shareholders report, I look at I read the letter. There's a letter that's on top, right? So I get the stockholders report, and this letter is real important to me because I don't have a lot of time. I'm very busy. And this letter basically lays out how the company did in the past, the present, and in the future. Typically the first element of the annual stockholders report and the primary communication from management. And sometimes I just read that, okay? And, financial reporting is basically international now, right? There's the International Financial Reporting Standards. Okay, so the first one we're going to look at is called the income statement, okay? And this basically will give you a financial summary of the firm's operating results during a specified period. And they usually do them as a 401k and a 401q, right? Usually 1 quarter or 1 year. So companies produce and release to the public quarterly and annual income statements based on their fiscal year, which may or may not align with a calendar year. Okay, so the timing may be different. So it says here about 70% of U.S. public companies align their fiscal year with the calendar year. All right, now I'm sure some of you are going to or have taken a class in ethics. Ethics is an important concept because there's a lot of earning shenanigans, as it says here, and this is worth reading about all the games that are played. And, a lot of companies play games to make themselves look better. All right, so we're going to use this company here called Bartlett, and we're going to follow all the way through the chapter with this, I guess, imaginary company called Bartlett. And they showed their income statement here for the year ended December 31st, 2019 and 18. You notice how they show you 2 years here of so you could compare for comparison. And now what they always do, income statements will always start out with your sales revenue. The biggest number on top, how much you sold of a product, a particular product. And then they work their way down with all your expenses, okay? And they work their way down with all your expenses. Now, you'll notice here that here's your sales revenue, right? And here's your cost of goods sold. This is what it cost you to actually make the product, okay? This is what it cost you to make the product. So you can see what it says. The cost of goods sold, we subtract that, which represents the amount remaining to pay operating, financial, and tax costs. So basically, a lot of things make up the cost of goods sold to make the product, and that'll leave you with your gross profits here, as you can see, right? You just subtract here, right? And then you got to basically subtract off your operating expenses, your selling, your sales and your advertising, and these are all listed here. And okay, so here's your total operating expenses. Okay, you'll notice depreciation is on here too, right? This is markdowns of your physical items in your company. You should look up the term depreciation. Okay. So basically what you do is you take your operating expenses and subtract that off of your gross profits, and you're left with what's called your operating profits. All right, now there's a next item here is called less interest expense. What that means is that's the interest you're paying the bondholders, the people who loan you money. You got to pay them interest, right? So you can see, you can write that off. So you can write off the interest to the bondholders. And when you subtract that from your operating profits, you're left with net profit before taxes. I'm sorry, a net profit, before taxes, right? And then, of course, you got to pay your taxes, right, like we all do, right? Then you subtract that. So now you got net profit after taxes. By the way, a lot of companies are very clever about getting around paying taxes, as you're probably aware. They move offshore. Okay, so then you got to, you have to pay the preferred stockholder dividends first. Remember, they got priority before the common stockholders. And then after you subtract that, you have what's left for the common stockholders. Again, they take the most risk, right? Because they're getting the breadcrumbs. All right, so that's how that goes for a basic. This is a very basic income statement, all right? And that's how that goes. All right, so I'm about 15 minutes into this part, and again, I don't like making them too long. So what I'll do is I'll do this as part 1, and then we'll pick up like right at this point right here. All right. Alrighty, I'll talk to you later.